Good day, everyone. Today we're going to discuss journalizing external transactions. So what books of accounts are these transactions to be recorded? After analyzing business documents and business transactions, journal entries are then prepared and recorded in the books of the company. In double entry accounting, transactions are recorded in the journal through journal entries. So, journalizing is the recording of transactions as debits and credits using appropriate account titles and filling out other details of the journal, such as date, amounts, and explanation. There are two kinds of special journal. There are two kinds of journals. We have the general journal and the special journal. So we have this general journal and special journal. So this is a more detailed presentation of the general journal. We have the date, account title, description, reference, debit, credit. So these are the common types of special journals. We have the sales, purchases, cash receipts, cash payment. What is a journal? Journal is just a logbook that contains a chronological listing of a company's transactions and events. The accounting journal serves to document business activity as it occurs. However, rather than including a detailed narrative description of a company's transactions and events, the journal lists the transactions by account titles, which are either debited or credited. The general journal is sometimes called the Book of Original Entry. This means that source documents are reviewed and interpreted as to the accounts involved. Then they are documented in the journal via their debit-credit format. As such, the general journal becomes a logbook of all the recordable transactions and events. The journal is not sufficient by itself to prepare financial statements. That objective is fulfilled by subsequent steps, but maintaining the journal is the point of beginning toward that end objective. That is why it is called the Book of Original Entry, because it is the point of beginning toward the objective of presenting financial statements. So we have the general journal and the special journals here. So we have the purchase journal. These are the common types of special journals. So purchase journal, sales journal, cash receipts journal, cash payment or disbursement journal, purchase return journal, and sales return journal. So this will be the accounting form on. This is the journal entry format. We have the date, the account name, the amount debited, and amount credited. So here will be the description of the transaction or the explanation for the transaction. Let's take, for example, the case of Teresa Corrales, who invested in Teresa drugstore. So she invested 25,000 on January 5, 2020. So what the business has after the investment will be the cash of 25,000 and the Teresa capital of 25,000. So after journalizing all the events or transactions that occur within the day or within the month, this will be the appearance of the general journal. So you have January 5, 6, 10, 12, and 15. Notice that It is chronological, meaning to say as the events happen. You cannot journalize first January. You cannot journalize January 6 transaction ahead of January 5 transaction, nor January 10 ahead of January 6 transaction. The journalizing should be in the order of appearance of the events or in the order of the happening of the event. So it is chronological. That is the meaning of chronological. So these are the common types of special journals. We have the cash is always a recurring, commonly used account title. So cash, anything that involves cash is recurring. So cash is, it is wiser to use cash receipts journal, a special journal, and cash disbursements journal. If accounting system were like coronavirus pandemic, which we need to flatten the curve, special journals are likened to a lockdown that flattens the curve. The recurring transactions are locked down in special records called special journals. The recording of recurring transactions is no longer made on the general journal, but on the special journal. The commonly used special journals, as I've said, are these four: cash receipts, cash disbursement, sales journal, and purchases journal. Cash receipts journal is used for all cash receipts transactions. So what are the common cash receipts transactions? You debit cash, what do you credit? Normally, usually, sales and accounts receivable. When the business makes cash sales, debit cash, credit sales. If it collects account from a customer, then debit cash, credit accounts receivable. So the headings of the cash receipts journal are the following. So we have the date, the account, this is the name, this is the for other transactions than this one. So we have the posting reference, then we debit cash, we debit sales discounts, we credit accounts receivable, and we credit sales. Other cash receipts journal may be loans. When business transacts loans, then cash is increased, and then this will be recorded in sundry column or other accounts. So in this column is provided for this sundry account because other transactions are already given title on the columns. So the next one will be the difference between a cash receipts journal for for a business maintaining a periodic system of inventory and for a business maintaining perpetual inventory system. So in periodic inventory system, cash receipts journal will only have debit cash, credit sales. But in debit cash, credit sales. But in perpetual inventory system, there is a corollary entry which calls for the recording of the cost of goods sold and the reduction of merchandise inventory. So there is this column. So the rest are similar except for this column because of the corollary entry being recorded in case of perpetual inventory system. So cash disbursement journal. This is a special journal used for recording various transactions relating to cash payment or disbursement. Businesses usually pay debts by checks. Payment by check is treated as a cash payment transaction. Cash disbursement journal is used for cash payments. Each entry includes a credit to cash. So we have here credit to cash. So what is the usual cost of a credit to cash? We have the purchases and payments of accounts. Other will be giving out loans. So similar with cash receipts journal. So you write the name of the debtor here when you use the other accounts. So the next, this will be the sales credit journal entry using periodic system, and this one using perpetual inventory system. So it's simpler with periodic because you only record the sales transaction. In perpetual, you have to record the inventory transaction or the cost of goods sold. So you debit the cost of goods sold, you credit the merchandise inventory. So this will be the appearance of journal without using special journals. For example, in our illustrative situations on Tarimacor drugstore on January 16, Tarimacor sold an account to Dr. Guevara, Dr. Pelayo, and Dr. Nuevo, and Dr. Ginding. So, for Dr. Guevara, 5,000, Dr. Pelayo, 3,000, Dr. Nuevo, 2,000, and Dr. Ginding, 1,000. So you take note that there is always an explanation for each transaction. So the entry to record this transaction as illustrated here will be very repetitive, although the merchandise and goods are medical supplies and medicines only, but the transactions are recurring, then it is wiser to use a special journal for this. So when you use a special journal for these transactions, for those transactions, you will have this kind of appearance in the journal, which is much, much better and simpler. So this is the illustration of sales journal using periodic system of inventory. So we'll just write down the date, the names of the debtor or buyer on account, then the invoices covering the sales to this clients, and then the amount. So you don't need to write the explanation for each of the transactions. This one, let's go back to this. This one is for the periodic. You don't have the account, cost of goods sold, and debit and credit, merchandise inventory. So the amount here pertains to the cost of the goods sold. So this is the selling price. This is the cost of sales. So this is the selling price, cost of sales. So because in a perpetual system of inventory, there is a record, permanent record for the cost of goods sold and inventory, from which you can determine the cost of the merchandise sold. So sales is usually with percentage tax or VAT. If the business is subject only to percentage tax, a column for sales tax can be included in the sales journal. So when the business is selling beyond 3 million, this will be subject to VAT, and VAT will necessitate a separate journal because there will be input and output to be recorded in the VAT journal, which have to be reconciled to arrive at the amount remittable to the Bureau of Internal Revenue. But if it is subject only to percentage tax, a column for sales tax will be added in the sales special journal for sales on account. This is an illustration of sales journal where there is a column for sales percentage, sales tax or percentage tax. So purchases journal. Purchases journal is used for all purchases of merchandise on account. Remember that purchases journal and sales journal are used to record transactions on account because cash transactions are already recorded in cash receipts or cash disbursements journal. You can use a single column purchase journal or a multi-column purchase journal. This is an illustration of a single column journal. So if you are only having accounts for purchases, then you will have a single column purchase journal. This is for the periodic system. It uses the account purchases. In this one, this is for perpetual because it uses the account merchandise inventory. All the other details are similar except for this account because when we purchase using inventory system, periodic inventory system with debit purchases, and when we use perpetual system of inventory, we debit the inventory, merchandise inventory. So this is a multi-column purchase journal. So same details. This one you have to choose whether purchases or merchandise inventory depending on the inventory system being used by the business. And then you use the multi-column. If it's not only purchases that you are acquiring on account, but other items in the assets as well, like equipment, loans, kung palautang. Pag palautang, multi-column. Pag isa lang inuutang, then single column. So recording of sales returns and allowances. This is another account title, no, to bill, which is peculiar to merchandising, sales returns and allowances. So the normal entry for sales returns and allowances will be debit sales returns and allowances and credit accounts receivable. So there are two methods of recording or approaches for making journal entries of transactions involving sales returns and allowances. A company may choose any approach depending on its volume of sales returns and allowances during the year. The first approach is to record sales returns and allowances in the general journal, and this is appropriate for companies that have few sales returns and allowances during the year. The second one is to record these transactions in a special journal known as Sales Returns and Allowances Journal, which is more convenient for companies that experience many sales returns and allowances during the year. So this one is for the general journal, the first approach, and then this one is for the special journal, the second approach. This is the special journal. So we have the details as date, credit memo number, customers, account credited, posting reference, accounts receivable, sales tax payable, sales returns and allowances debit, inventory debit, cost of goods sold credit. So the usual entry for, as we have studied, the usual entry for sales returns and allowances is that debit sales returns and credit accounts receivable. So you will see that here, naka-credit yung accounts receivable, naka-debit yung sales returns and allowances. Kaya lang pag nagsoli ka, then syempre re-record mo rin yung sales tax dun para sa sales na yun. And if it's using perpetual inventory system, you have to record the cost of goods sold being returned. So when a customer returns the goods, an allowance is allowed to him. The seller prepares a credit memorandum. So we have here as a source document the credit memo. Credit memorandum, abbreviated as credit memo or sometimes called credit note. So this contains information about type, quality, quantity, price, and related invoice number of the goods being returned. The original copy of the credit memo is sent to the buyer to inform him that the return or allowance has been approved and his account has been credited. A duplicate copy of the memo is kept by the seller, which acts as a source document for recording journal entry relating to sales returns and allowances. So there is another kind of special journal, which is purchase returns journal. This special journal is used when the volume of returns is big. Purchase return journal is a special journal where purchase returns of credit are recorded. In the case of isolation of purchase agreement or in the case of defective goods, the purchaser returns the goods to the seller. While returning goods to the seller, a slip containing reasons of return of good is sent along with the goods. This is called debit memo, debit note, or short for debit memorandum. Or debit memorandum. Debit memo is short for debit memorandum. The seller also sends a note to the purchaser as a reply, which we have discussed earlier, which is the credit note or credit memorandum. It may be mentioned that goods purchased on cash, if returned, are not recorded in the purchase return journal. Okay, that will wind up our discussion. End of the slide. Our next discussion will be on the next discussion will be on the posting to the ledger.